Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. Wow, these markets are truly resilient, aren't they? We had some downturn in the markets at the start of August, the end of July, and these markets have just picked right back up and are pretty much at all-time highs once again. It was funny at that time, I guess not funny, but in that a lot of individual investors were calling me, sending me messages back at the beginning of August are things about to really fall? Are we about to see a pretty large pullback in the markets, a correction, perhaps something in the vicinity of 10 to 20%? A lot of people were nervous. And here we are, I guess 3 weeks later, markets back at all-time highs. And I guess the answer looking back now was no. This market did not continue to fall. And we're going to address why it did not fall and why, as I said a few times on this show and my radio show as well, why I felt that the sell-off was overblown. So we'll get into that and a lot of other great information for all of you today. So let's show our topics for today. First topic, market plunge, alarms investors in early August and then bounces back quickly. I just mentioned that. We're going to talk a bit about why I felt that it was actually a buying opportunity, that the sell-off was overdone. U.S. economic data and the Fed rate decision. We have a rate decision coming up by the Federal Reserve coming up in September. I think in and around the 18th of September, if I'm not mistaken. So a little bit after our rate decision up here, Bank of Canada rate decision in early September. Will they cut rates? How much will they cut if they do cut? A lot of discussion about that. So we'll talk about that. Top 3 things to consider over the next couple of weeks before you make your investment decisions. As always, I'm going to talk about 3 points, 3 ideas that I think individual investors should be mindful of or paying attention to. Canadian inflation and the Bank of Canada rate decision. We're going to talk about Bank of Canada and the rate decision. We just received some CPI data yesterday. Looks like inflation is cooling even more, down to about 2.5%. Will this set the stage for another rate cut by the Bank of Canada? We'll discuss. What's a me session? We know the term recession, but what is a me session? And this is a term that I came across in the last couple of weeks. Thought I'd talk a bit about that. I think everyone's going to perhaps, understand when I explain what it is. I think everyone is dealing with a little bit, at least, with a me session at this point. So we'll explain what that is. Quick hits, the part of the show where I talk about 3 things that are in the news that some of you, or maybe all of you, have come across and have read about. We'll talk about 3 things. I'll touch on them, give a couple of points on each very quickly. And lastly, of course, your questions. I always seem to get to 1 or 2 of your questions. If you have any questions during the course of the show that you would like to ask me, please put them in the chat box. I'd be happy to answer them at the end of the show, or if I don't get to them, I will definitely get to them on the next show, or perhaps during the 2 weeks between this show and our next show. So without further ado, let's move on with the show. So the plunge that we saw at the beginning of August, and by now we've spoken about it a few times, as I said, on my radio show. I've spoken about it with investors a number of times. And I guess we have to start by discussing why it happened. And I think it kind of breaks down, when we look back now into 3 reasons why it happened. Number 1, and probably the most important reason, was the jobs data we received out of the US. We were expecting to see about 180,000 jobs created in the US. And the US only grew about 114,000 jobs for the month of July. We also heard from Nvidia, a very important stock, which we're going to talk a bit about it later on this show. But we heard from Nvidia, or at least we heard reports that perhaps the new chips from Nvidia, the Blackwell chips, would be delayed until the new year. What effects would this have on a lot of big tech companies? Well, probably a pretty big effect. So if it is true and Nvidia is delaying their chips to the new year, to the new chips, the new Blackwell chips, would this have a negative impact on tech stocks, on other chip makers, on some of the hyperscalers like Microsoft and Amazon and Google, etc. So that was a bit of a fear that we heard at the same time as well. And lastly, there was talk, or there was some issues out of Japan. Japan had an interest rate increase recently, and that caused a bit of a panic. It's been a while since Japan raised interest rates, the carry trade, as we call it, basically taking Japanese dollars and investing in the US because US had a lot higher interest rates than Japan did. Japan's rates were always very low, next to nothing, whereas they could take their money and invest it overseas. Well, if Japan's raising rates and if the US is going to start cutting rates, that trade opportunity is getting less and less. And so that caused a bit of a panic because maybe perhaps some of the Japanese money that had been coming into the United States would start to pull out. So those three things really made us quite nervous. But looking back, I said to investors at that time, I did not believe that the pullback was justified. 115,000 jobs created for the month of July, I thought was good enough. Yes, we saw a new number given to us for the month of June. So the month of June was redone or I guess recalculated, and it came in below 200,000 jobs created. It was over 200,000 jobs. I believe it came in at around 179,000 jobs created. So a new number, but at the same time, it's still a good number. And this talk about, well, we have to fight inflation quickly became to talk about, is the United States actually headed for a mild recession? Has the Fed not moved quick enough in cutting interest rates? And to me, this fear was one that was created by investors themselves. I think it was created by investors. It was created by the programs, the computer programs that were trading on that day. And if you recall, it was the Monday of our long weekend here in Ontario, civic holiday. It was the Monday of the long weekend where the US markets, Dow Jones dropped over 1,000 points. So I believe the fear was overdone. And I guess my main message to all of you watching today, understand and remember this time, because there's going to come another point in time where the markets pull back and investors are going to be fearful once again. And I'm hopeful that a lot of you investors will remember these past experiences and take something from them for the future. Don't panic. Don't call your advisor, wanting to know whether you should be selling everything and moving to cash. That is not what we do, not what we want to do, especially if you're a long-term investor. We want to take advantage of these pullbacks that aren't for fundamental reasons, and I don't believe they were for fundamental reasons. The fundamentals in the United States are very strong. Fundamentals in North America are strong. Around the world are strong. So to fear a very large pullback, one of 10, 20% at this time, I thought was silly. And so those that took that approach and used this as a buying opportunity, bought on the dips, they made quite a bit of money over the past few weeks. So let's look at a few charts to illustrate what I'm talking about. First chart we have is US job creation. And as you can see here, 114,000 jobs for the month of July. We can see that as I said, the prior month, June, was revised down below 200,000, 179,000 jobs. And you can see the last 3 months, a nice steady decline, again, causing fear in the markets. But we know that, I guess, a few weeks before, maybe I think it was maybe 10 days before, we actually received or saw a GDP number out of the US, so a growth number out of the US, which showed nice growth. And we have a chart on that. Gross domestic product in the United States, there it is, 2.8%, well above what it was in the quarter before. And so, yes, maybe not as much as the fourth quarter, but still, when you come in at almost 3% growth in the United States, that's a pretty good number. So yes, we saw some weaker jobs numbers, but we saw some really good growth, GDP growth out of the United States. And shortly after we saw the job data, retail sales came out just a few days. And let's show a chart on that. We actually saw a full 1 percentage point increase in retail sales, well above what they were expecting. I think they were only expecting something like, well, less than half a percentage point. And now retail sales, 1 full percentage point month over month. So what does that mean? Well, that means individuals are spending money. The consumer continues to consume, spend money. Yes, they may be consuming on their credit cards. They may be borrowing money, but they are still continuing to spend money. So I think, in my opinion, this economy is far from a recession. United States economy, that is far from a recession. But let's take a look at what happened at the beginning of August. Let's take a look at a chart of the S&P 500. Chart of the S&P 500, there you have it, beginning of August. What a major downturn. And this is what caused the fear for investors. Is this something, the start of something bigger, or is this going to be an opportunity? And as you can see, it clearly was an opportunity, a short-term opportunity. Let's look at our next chart, which is a chart of the VIX. Now remember, this is a volatility index. This measures volatility, fear out there in the marketplace. And look at that spike. Wow, up over 65. We haven't seen a spike above 60, in around 65 since COVID times, since the recession, the financial crisis. So was this a time that would equal out the same time we had during the pandemic or the financial crisis? Absolutely not. Well overblown. And I can tell you now, the VIX index, or the volatility index, is below 15. So it spiked up to 65 and has come down to below 15. So was it overdone? Absolutely. Was it an opportunity, especially for buyers or investors that had some cash on the sidelines? Absolutely. So keep in mind, when these things happen in the future, you want to look at what you can do to take advantage of this time, especially if fundamentally the market is doing well, if fundamentally the economy is doing well, as we saw in the United States, 2.8% growth. So instead of being nervous, being fearful, try and take advantage of the opportunity. And that's the best advice I could give to all of you going forward. But keep in mind, every time these things happen, you want to assess why they're happening, which is very important. And then you want to act appropriately based on your assessment, on your research. And in many instances, you will find that the right thing to do is not sell, but in fact, be a buyer of this market. U.S. economic data and the Fed rate decision. As I mentioned off the top of the show, the Fed will announce, their interest rate policy third week, roughly 2.5 weeks, 3 weeks into September. And a lot of people are expecting a 1/4 point cut. There was some talk that we may see as much as a 50 basis point cut. As when we went through beginning of August, many people were fearful and they thought maybe the Fed should cut even before the next meeting, kind of have an emergency cut. Well, I think those fears are taken off the table. And I also believe that a 50 basis point cut has been taken off the table. And I think the Federal Reserve will cut 25 basis points, and they may cut 25 this meeting, 25 the next meeting, and 25 basis points once again in the last meeting of the year. But it is my opinion that, and it's been my opinion, as I'm sure most of you will recall, that we could see a couple of rate cuts before the end of the year. Perhaps we could see as many as 3, but I'm going to hold out and say, let's go with 2. And if we do get a third, well, we'll deal with it at that time. And I guess the main reason for a cut is because we're seeing inflation coming down. First chart that we have clearly shows this. The Consumer Price Index, CPI reading. We got a reading of 2.9% for the first time. We can show that U.S. Consumer Price Index now. There it is. It is the first time that we've seen a 2 in front of the headline number. When you strip out volatility, energy, and groceries, so the more, I guess, the number that the Fed looks at more, right, which is the core number, that's still above 3.2%, but that was higher as well. That was 3.3%. It's dropped down to 3.2%. So we're seeing consumer price index falling. Next chart that we have will show you the PPI, which is the producer price index, which these are your wholesale prices. And I think the most important thing here to see is final demand services starting to come down, 2.6%. You see, in the United States, inflation has been very sticky, as we know, and that's been mostly in the services sector. So now we're finally seeing the services sector start to fall. We're seeing final demand of goods, and we're seeing final demand in general, 2.2% on PPI, a great number, getting close to that all-important 2% number. And finally, we have a chart on PCE, which is your personal consumptions and expenditures. Here we are there, and we can see it down 2.5%. So we are getting close to the Fed's number of 2%. I think it's just a matter of time before we get there. And I think the Fed now can look back and say, you know what? Yes, we're getting close to our number. We're on our way to seeing or meeting target of 2%. We don't need to have interest rates well above 5% at this point in time. Double where the inflation rate is when you look at PCE. And keep in mind, yes, we are seeing some strength. GDP is strong. We're seeing retail sales. The last number was strong, but we're still seeing issues, slowing jobs market. Job openings are coming down. Hires are coming down. Jobs growth, right? Only 114,000 jobs created in the United States. That is coming down. So we are seeing slight weakness to help bring down the inflation, but still seeing strength in certain areas so that we get that soft landing, that landing of the markets, the way the Fed wants, the way all of us want, where we can see inflation coming down, but yet still not have the U.S. economy or the Canadian economy, for that matter, fall into recession. And so with these numbers falling and showing us a significant reduction in inflation, I think you could see the Federal Reserve cut in the next meeting by 25 basis points. Now we come to a part of our show that has become very popular for many investors. They like the top three. We always have a top three list of things I think individuals should consider before they make their investment decisions. First one, as you can see here, seasonal factors. What do I mean by that? Well, this time of year, markets tend to be a little bit soft. Why? Well, one big reason is there's nobody around. How many people do you know are on vacation, either outside the country, outside the city, up at their cottage? How many people are just taking days off, not coming into the office? Quite a few. And so trading volumes are at the lowest that they are for the year. This time of the year, trading volumes, the amount of trades going through the TSX, New York markets, are at their low point. So if there is a big headline that comes through and a bunch of investors move in one direction, they can really move the market in that direction because there's not a lot of trading going out there to counterbalance that movement. So seasonal factors, this time of year, August and into September, tend to not be the best months of the year. Even beginning of October tends to be a bit soft as well. We'll talk a bit about that. Nvidia, they're about to report earnings August the 28th. They are the last Mag 7, the Mag 7, Magnificent 7 to big cap tech stocks, as we talk about. They're the last to report. And obviously a huge market mover. Nvidia, one of the largest companies in the world, largest chip maker in the world, with dominating artificial intelligence, over 90% of the market with their chips. What are they going to say? Can they continue to grow at a pace that the market would be happy with? Last time they reported, they had a 200% growth rate. That is just unbelievable. Can they maintain that growth rate? I'm a little nervous. I'm not so sure they can. And if they don't, what if they only grow by 100%? Still a fantastic number, but the market may say, well, maybe that last number, the one before this one, was as good as it gets, and now we have to reevaluate what Nvidia is doing. So we'll talk about Nvidia. And the third point, bank earnings, Canadian bank earnings. And I bring this up because as investors in Canada, many of us own the Canadian banks. What do I expect, and what should we be looking for? So let's take our first one, which is seasonal factors. And our first chart kind of shows it best. We have a chart here, and it not only is it going to show us seasonal factors or the months of the year, which is what we have, but it's also going to show it in a presidential cycle. So the fourth year of a presidential term, which we know we're in. We're going to have a U.S. election in November. And you can see here how the months fare. Normally, August is a bit of a soft month, but in a presidential election year, August tends to do well. And we're seeing that this year as well. This month of August, even though it started soft and difficult, but has now picked up steam, and it has been doing phenomenally well. Markets are doing great on both sides of the border, Canada and the U.S. But this is where I start to get nervous. Let's take a look at September. Now, in September, historically, even if it's not an election year, September is a bit of a struggle. It is the worst performing month of the year. Now, does that mean that all of us should sell our investments and get out of the market for the month of September? Absolutely not, because obviously you never know what this year brings. As I said, normally August is a difficult month, but here we have August doing well. September, as you can see here, negative 0.46%, followed by October, negative 0.34%. And then as you get closer to the election, November does well, and December does well as well. So these are kind of the seasonal factors. And when you look at September, what's happening in September? Well, you're going to have an interest rate decision. And let's go to the next chart here on interest rates and what the market does when you get an interest rate cut out of the Fed. You can see here that when you get an interest rate cut from the Fed, which is your purple line, what happens to the S&P 500? So just before 2010, so 2008 or so, you had a cut and the markets fell. Then moving forward to the next time the Fed cut, back, I guess, 2021 or so, market fell. There you have twice where the market has fallen, just the two examples. But I think this could be a third one in the month of September coming up. Why do I think that? Because it's one of those things where the market has already priced in a Fed cut of at least 25 basis points. So if we get 25 basis points, I think investors are going to say, okay, well, tell me something I didn't know. We're going to sell the news, even though investors bought into the rumor of the cut. So they're going to sell the news or buy the rumor, then sell the news. And I think the market could have a bit of a sell-off in and around when the Fed cuts rates in September. Obviously, there are no guarantees, but I think it is a possibility. So if it happens, obviously we should be prepared. Again, maybe look at an opportunity to make a buy, take advantage of a dip, because I think the rest of the month or maybe even the rest of the year will be quite strong. So seasonally, I think September is weak. We could have some weakness. We have an interest rate, an announcement by the Fed, by the Bank of Canada. Bank of Canada doesn't mean as much for the markets as the Fed does. If they cut, we could see maybe a bit of a disappointment. If they cut more than 25 basis points, well, maybe that may strike a little fear in the markets, or maybe the markets will even like that because they're not expecting it, and maybe the market moves higher. So we'll have to see what happens, but just be mindful that seasonality is something that individual investors should have on their minds at this time. Second point, Nvidia earnings. I think we all need to pay attention to Nvidia earnings. It has become one of the largest companies in the world. I think they're still the third largest company in the world, although they're gaining on Apple and Microsoft. Apple being the largest, Microsoft in the 2 spot right now. What I've called many times the $3 trillion trio, right? $3 trillion in market cap for Apple, Microsoft, and Nvidia. And Nvidia has done just phenomenally well in the last little while. Let's take a look at a chart of Nvidia. You can see here the amount of gains that we've seen when I guess that long weekend in August, when it was a long weekend here, when the Dow dropped over 1,000 points, Nvidia touched a low point under $100 a share. It had been as high as 140, went down below 100. And looking back, what a buying opportunity that would have been. And today, sits in and around $128, in and around 130, let's call it. They're about to report earnings in the next week or so, and it's going to be a big market mover. The next chart or information piece we have here, actually it's a bit of both, information and a chart, talks about, there it is, stock has gained 31% over the last 8 days. 31% in 8 days. So if you're an investor that bought on the dips, I'm sure you would be very happy over the past week how Nvidia has done. And as I said, it will be a market mover. It's going to move tech stocks. It's going to move other chip makers. It's going to move the market as a whole, the S&P 500. So it's definitely an earnings report we're going to want to see after the market closes, I believe on the 28th, and definitely don't miss that. The third and final point I think individual investors should be focusing on are Canadian bank earnings. And as I mentioned, with, I guess, individual investors here in Canada, we own a lot of bank stocks, right? Bank stocks make up the largest component of the Toronto Stock Exchange. There are your top 6 banks, and they're all set to report, starting with TD and then BMO Scotia right after the following week. I have a couple of charts on two banks in particular here. TD Bank stock, which I've spoken about as a buying opportunity many times on this show, many times on my radio show. They've had a lot of issues with money laundering. There were some charges, an investigation still, I believe, being done. Stock got down to the low 70s. You can see it there in, I guess, in the month of June, 72, 73 in that range, and it has now gone up. I had a bit of a blip during the beginning of August, like everything else, and now it's back well above $80 a share. Dividends at one point were almost 6%. Now they're just around 5% because the stock has gone up. And again, TD Bank is a name that I think you can take a look at. Scotiabank is the second chart we have. Scotiabank will report earnings the following week. And they just made an acquisition, actually, but a stake, 15% stake in KeyCorp, a regional bank in the United States, paying a few $1 billion for it. I think it's a great opportunity. Scotiabank has talked about how they want to get more into the U.S. market, less in places like South America, Central America, but they want to get more into the U.S. market. Buying this regional bank, I think, was a great idea. Good for KeyCorp and good for Scotiabank exposure. But it's just an opportunity. I think when they announced the buy, stock went down because anytime companies announce a buy and they're spending money, I think the knee-jerk reaction is to sell the stock because they're spending money. But quickly, investors realized that was the wrong thing to do, and the stock has gone up again. Overall, I guess when you look at all the banks, you want to look at what they're going to say about loan loss provisions. You want to know if they're setting aside even more money for bad debt. Keep in mind, individuals have to pay more for their mortgages, more for their loans, more for their credit cards. There's issues obviously in areas such as commercial real estate issues. With these interest rates as high as they are, yes, coming down, this is caused some issues for businesses, for individuals, and obviously the bank is feeling it and has felt it over the last bunch of quarters. So what's the bank going to say? How's the consumer faring? Are individuals still borrowing money? What's the situation with respect to loans? Are they growing their loan book? How's their wealth management divisions? All this, trading, all this is what we want to hear from the banks and what they say. Will any of them raise their dividends? If they do, it'd probably be very, very slightly. Will they buy back shares? All of this is what we're going to be listening for. And the good news is, with regards to Canadian banks, U.S. banks always go first, and they reported some really good earnings. So I'm hopeful that we're going to see some really good earnings out of the Canadian banks as well. So will the Canadian Bank or Bank of Canada, will they cut interest rates a third time in a row? I don't remember the last time I remember the Bank of Canada cutting rates 3 times. But then again, I didn't remember a time when the Bank of Canada would raise rates almost, I think it was 10 times over a course of about a year, just over a year, year and a half. So will they cut rates for a third time? And I think that all depends. We just received, as I mentioned off top of the show, just yesterday, the CPI reading came in at 2.5%. I think we have our first chart which shows that. And when you compare, there it is, the CPI rating of 2.5% to the Bank of Canada rate, which is 4.5%, almost double, there's a lot of room to cut rates. You couple that with other things such as productivity, which we'll talk about in a second, and other slowdown in GDP in general, the bank has perhaps a good reason to cut rates for a third time in a row. Our next chart shows what they've been doing, the Bank of Canada has been doing over the last little while. You can see there's been 2 cuts there. There it is, Bank of Canada rate policy rates. You can see the last 2 quarter point cuts. You can see the chart on the left clearly shows this. And it's good because you can really gauge what the Bank of Canada feels they need to do. Bank of Canada has been talking about this whole slowdown in the economy, how we're just skirting by in terms of a recession, not falling into a recession, but we are pretty close. I think last GDP numbers were less than 2%, just above 1%. And a lot of that has to do with the fact that we're bringing in a lot of people to the country. They are spending money, and that is why we seem to be, or seem not to have fallen into a recession. But if you look at, I guess, growth on a per capita basis, when you look at it on a per person basis, you could make the case that we actually could be in a recession. And the only reason why GDP is positive is because of the amount of people that have come to our country and that are spending money here, amount of immigrants that have been brought to our country. So will the Bank of Canada cut rates? Keep in mind, jobs growth. If you're looking at jobs data, we've seen two negative numbers, negative jobs. So meaning losing jobs in Canada over the past couple of months. There are some provinces like Ontario that have managed to still grow jobs, but for the most part, the country as a whole has been losing jobs. So jobs are being lost. GDP is flat at best. Productivity, something that Bank of Canada talks about all the time, that has slowed. We are the worst out of all the major G7 nations in terms of productivity. We're not being productive. A lot of reasons for that possibly, which perhaps we can get into another time, but overall, the productivity is just not there in our country. So with all that said, slowing of jobs, and obviously inflation coming down to 2.5%, almost reaching target, productivity down. This is, I think, a reason why you could see a third rate cut in a row by the Bank of Canada. I know all the major banks are calling for another rate cut. They're looking to see perhaps one rate cut in September and at least one more rate cut before the end of this year to bring the Bank of Canada rate down to about 4%. Right now it's 4.5%. So we're looking at shaving off 50 basis points by the end of the year. And yeah, I think this would definitely spur on more activity. It would definitely help the banks, help individuals with their loan payments, their mortgage payments. Obviously, prime rate is still pretty high in that 6.7% range. If you cut another 50 basis points by the end of the year, you're now getting closer to 6%. And then you could see maybe as many as 4 more cuts next year. So will the Bank of Canada cut rates? I think they will. I think they will cut for a third time. There really is no reason for them to remain on hold, especially when the gap between the Bank of Canada rate and where inflation is right now is 2%. They have a lot of room to cut interest rates. And I think you will see a rate cut in the first week of September. A me session. We all know, unfortunately, what a recession is, but what's a me session? And it's a term that was brought up or created recently, and it's been floating out there. And really, simply put, a me session is all about us as individuals. The fact, as I just mentioned in the previous segment, the fact that in Canada, we're not in a recession, right? We don't have 2 negative quarters of growth, back-to-back quarters of negative GDP or negative growth. That would mean we'd be in a recession. But a me session means that to all of us, each individually, we do feel that we're in a recession. Inflation, even though it has come down at 2.5%, understand that that just means prices are going up by 2.5% this year, on top of the maybe 4 or 5% they went up last year, on top of the 8% inflation rate that we had a couple of years ago. So this is 2.5 on top of last year's rate, on top of the year before's rate, et cetera, et cetera. So it's not that prices are coming down. They're just going up slower, but they're still going up. And we're feeling it. The average person is feeling it. Even though the price of groceries is not going up as much, it's still going higher. Even though price of travel, price of services, price of everything, price of goods in general, it's going up. It's just not going up by as much. So for the average person whose wages aren't meeting the increase that we've seen in inflation over the last few years, it's been difficult. It's been difficult to make ends meet. And we've had to borrow money to, I guess, account for or compensate for our wages not being able to keep up with the rising inflation that we've seen in our country. Our first chart here debt to disposable income here in Canada. And you could see, I guess, the latest number and then what it was in 2013. For Canada on the far left, you can see that the latest number in and around 180%. So $1.80 for every dollar that we make, we spend $1.80. You can see all the different months. Obviously, Ontario and BC, the two bigger provinces. Quebec, not as bad. But Ontario, a lot more debt being taken on than we saw in 2013. BC, actually, less debt than it was in 2013. But let's take a look at Ontario. Ontario was spending $2 for every dollar that is made. So it is, people are definitely spending beyond their means, and they're having to put things on credit cards. And we are seeing defaults. Defaults are higher. Unfortunately, bankruptcies are up over the last few years. And what does that mean? Well, we're seeing it in bank earnings. Canadian bank earnings, as we just discussed, they're coming out, and let's see what they say about allowance for bad debts. But yet, even though we've seen people continue to spend and rack up credit card debt, this is the productivity. If people are spending money, you'd think people would be more productive, and it's just not happening. And as I said, the amount of immigration that has come into this country, so the amount of people has increased, so therefore the spending has gone up, but the productivity has not. We're nowhere near as productive as other countries around the world. And our next chart here clearly shows that, a drop in Canadian productivity. And you can see how we fare. There's Quebec in light blue up the top, Canada right after. Ontario actually is better than the average, better than Canada, better than the average. But you can see the average of OECD countries is well above where we stand. So productivity is definitely, productivity growth in Canada is there's really just no growth in productivity. And this has been one of the comments Bank of Canada has made, and why, one of the reasons why they've begun cutting interest rates, because they're fearful of our productivity in this country. Next chart that we have here shows Canada or Canadian versus US productivity. So this is comparing us just to the US. And there is obviously a very big gap in real GDP per capita, per person. How much the average person is, how well the average person in the US is doing versus how well the average person in Canada is doing. You can see the Canadian line just kind of tapering off down to the bottom right, whereas the US has been moving nicely higher to the top right from the bottom left. We seem to have kind of peaked out, I guess, in and around just middle of or beginning of 2022, and now we seem to be coming down, and that is a problem. That is a problem. If we're not being productive, we're not growing, we're not creating, this is no good for a country that needs growth, that is looking for growth, that is looking to see a growth number above 2%. And our next chart here, again, shows what I was saying about immigration. You can see on the far right-hand side how much immigration we've had, people coming to our country, which is great. Don't get me wrong. I'm not here to say that we shouldn't let in people to our country. Absolutely, we should. But we need to have better productivity. We can't just rely on new people coming to our country to spend money to help our GDP move higher. We need to grow. We need to expand our businesses. We need to have new businesses pop up. We need to have more business spending. We need people to want to be productive, want to expand. And unfortunately, a lot of individuals feel that the environment here for that, under our current tax system, under our current government, is just not conducive for that. And that's been a big, rallying cry for many individuals here in Canada. We'll see what the federal government can do. But overall, right now, it's just whatever we're doing does not seem to be going the way we want it to go. So what is a me session? A me session, very simply put, is just we may not be in a recession here in Canada, but for each individual person, me and you and all of us watching today, a lot of us are feeling that we are in a recession based on our jobs, our wages, and many other things that go into calculating what an actual recession is. Quick hits. This is where I talk about three things that have been in the news that have caught my eye and perhaps caught the eye of many of you watching today. Starbucks changes CEOs. We're going to show you how powerful good management is. And when you have or bring on a great CEO that has done really well from where his previous job was, how powerful it could be for the company, but also the share price of their stock. Canadian home sales have been flat. They've gone up year over year, but still running near at the 10-year average. And finally, U.S. oil production hits record highs. This is something I've been talking about on our show for, I think, a few years now, how the United States has become the largest producer in the world of energy today, picking up the slack for OPEC nations, for Russia. The United States just continues to produce. So let's get to the first one here. Starbucks changes CEOs. And it's quite interesting to see their charts, how powerful when you change management, how powerful that could be to your company shares. And there we have it. Starbucks. Look at the spike in shares. I believe the stock went up over 20% that day where the announcement was made that the Chipotle, everyone knows Chipotle, restaurant chain, their CEO was leaving Chipotle and taking on the job at Starbucks. If some of you recall back to when the CEO took over at Chipotle, so the new Starbucks CEO took over at Chipotle many years ago, the turnaround that was made at Chipotle. Chipotle restaurants were not doing as well. CEO came in, turned everything around, and I guess now he's perhaps looking for different challenges or more challenges, and now he's decided to jump ship to Starbucks, which has clearly been struggling not only as a company, but obviously their share prices as well. Let's take a look at Chipotle chart. You can see here just after the 12th of August, you can see a sharp decline. So Starbucks higher, Chipotle down in terms of share price, and that is all to do with the announcement of the Starbucks CEO leaving and the new CEO from Chipotle coming in, who has worked wonders at Chipotle restaurants. And a lot of people believe that he's going to do a lot of good things for Starbucks. The second quick hit that I touched on briefly already, Canadian home sales flat for basically really for quite a while now. And we have a chart to show this. You can see here that overall, the home sales in July were slightly down month over month, 0.7%, but up about, well, just under 5% from the same period last year. There's your 10-year average. You can see it spiked above in between 2020 and 22, then below 2023, and remains below the 10-year average in 2024. But overall, you can pretty much draw a straight line across, and it's been pretty flat. And I think one of the reasons why things have come down recently is obviously interest rates. Interest rates being at a high for as long as they have been in our country, that has caused home sales to soften. I think going forward, if we do see a cut in September, followed by another cut, at least one more, maybe two more this year, and then we see another 3 or 4 cuts next year, we can bring down that bank rate, Bank of Canada rate down, bring down prime rate to somewhere. Be great if we could see it in and around 4.5%. I know it's still over 6% today, but if we could see it, I guess maybe even at the very least 5%, I think that would work wonders for the housing market. And you could see a pretty active housing market, buy-selling season in the spring of 2025 if they can cut rates a number of times before then. Not sure if the Bank of Canada wants to see that, because the last thing I think they want is a red-hot housing market, which would lead to higher inflation. But definitely, I think rate cuts will spur on a nice rally and activity in the housing market. I know, talking to a few of my mortgage advisors or real estate individuals, they'll be very happy. Mortgage brokers and real estate agents will be very happy to see an active spring housing market. The third point to touch on, which is U.S. oil production. And this is interesting because when you talk to, or you hear, I should say, Republicans or former President Trump speak, he talks about how he's going to drill, baby, drill. And that's great. And he talks about how by drilling It's going to bring down inflation. They're going to be the most dominant, United States will be the most dominant oil producer in the world. Well, I got news for former President Trump. They already are. The United States is already the most dominant oil producer in the world. Now, you want to go from 13 million barrels a day to 14 million barrels a day? Sure, that's great. You want to produce more natural gas? Sure, that's great. But the United States is already the most dominating and largest oil producer in the world. We have our first, or our chart on that to show. We could, here it is. And it talks about, there you have it, breaking news. U.S. crude oil production has officially hit a record 13.4 million barrels per day. Daily oil production has increased by 22% over the last 4 years. Since 2008, production has skyrocketed 350%, 3.8 million barrels per day. The U.S. is now the world's largest oil producer. You can see the chart here, which clearly shows the oil production. It's just fantastic. It's come at a time where the world needs it, right? When you hear about cutbacks by OPEC nations, Saudi Arabia, Iraq, and many other nations that make up OPEC. They've been cutting back, especially the Saudis, who used to be the largest oil producer in the world. The fact that the U.S. has come at a time, their production increases have come at a time to help the rest of the world has been fantastic. You couple that with what's going on with Russia, Ukraine, and obviously countries no longer importing oil from Russia. The United States has definitely picked up the slack. So these are 3 points, 3 things in the news that I think many of you may have seen, wanted to comment on each of them. But I think, as I said, the most staggering thing for me is understanding that the United States is now the largest energy/oil producer in the world today. Now we come to the part of the show where I get to take one of your questions today. Again, I usually limit it a little bit if the show goes a little bit long. And I have a question, and I guess it's pretty good timing for this question. It's probably why it came up in the questions that came through. Do you see a market correction coming? Well, we just had one. With the recent volatility in the market, it is making me wonder if it is a good time to move my money out of the markets. What are you telling your investors? So we touched on this during the show. Do I see a correction coming? Well, understand that in any given year, you're probably going to see 2 or 3 corrections. That is healthy and that is normal. We saw one in April. We saw a correction in early August. Maybe we'll see another one in September. Maybe it'll be caused by what the Fed does with interest rates. Maybe it won't. Maybe we'll see great markets in September and the rest of the year. We just don't know. But on average, yes, I do expect to see a couple of market corrections per year. Is that cause to move money out of the markets? My answer is no. I don't believe it is a cause to move money out of the markets. The only time I would say for an investor to move money out of the markets is if you have a very, very short-term time horizon, like you need the money next week or maybe even next month, and the markets are showing some volatile signs. Yeah, maybe you want to put the money on the sidelines, keep it out of the market, so at least you know that this is the amount of money you have to do whatever you need to do, buy a house or buy some sort of big ticket item or whatever you need the money for. So if it's a short-term basis, yeah, maybe you move money to the sidelines. But for most of us, we're going to be invested, 3 months, 5 months, 1 year, 3 years, 5 years from now. And so these blips in the market corrections end up working out and the market tends to go higher after that. So that's basically what I'm telling my clients. Don't panic. Understand why a market corrects. Understand what opportunities lie in front of you and take advantage of the opportunity. Don't panic and sell because perhaps your next door neighbor or a friend or a relative is getting nervous and has sold. That is not what we want you to do, not what I want you to do, and that's what I tell my clients. So with that, I want to say thank you to all of you for joining me today for another, information-packed show. I hope all of you were able to take something from our show. Please remember to join us again in 2 weeks' time, which would be Wednesday, September 4th. Wow, I can't believe it'll already be September. Kids back to school. It'll be, a back-to-school show that we will have at 12 noon, as always. And until then, happy investing.